Most people hear the word bonds and get confused. They think it's complicated, boring, or something only old people invest in. But here's the thing, most people have no idea how they actually work, and that confusion costs them. By the end of this video, you'll understand how bonds work and how to use them wisely in your portfolio. We're covering what they are, how they make you money, and the critical risks you need to know before buying your first bond. Let's break it down. So what exactly is a bond? Here's the simplest way to think about it. A bond is an IOU. When you buy a bond, you're lending money to a borrower, usually a government, a city, or a corporation. And just like any loan, they promise two things. First, they'll pay you interest at regular intervals. These payments are called coupons, and they typically hit your account twice a year. Most bonds offer a fixed interest rate that doesn't change after the bond is issued. Secondly, they'll pay back the full amount you lent them on a specific date called the maturity date. Let me give you a concrete example. Say you buy a $1,000 bond from the US Treasury with a 5% coupon and a 10-year maturity. Here's what happens. Every 6 months, you receive $25 in interest payments. That's $50 per year. In 10 years, you get your original $1,000 back. Pretty straightforward. You lend money, they pay you interest. You get your principal back at maturity. Now, you'll hear the term yield a lot when people talk about bonds. Yield is simply the annual return you're earning on the current market price, expressed as a percentage. With the example I showed you, the 5% coupon is fixed, but your actual yield changes as the bond's price moves. Additionally, the amount the bond is worth when it's issued is known as face value or par value. Most bonds have a face value of $1,000. Now, let's look at how interest rates affect bond prices. Here's where bonds get interesting and where many beginners get confused. After a bond is issued, its price doesn't stay locked at its face value. It goes up and down every single day. And the reason is tied to interest rates. There's a fundamental rule you need to remember. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. They move in opposite directions, always. Let me show you why. Imagine you bought a $1,000 bond, paying 4% interest. A few months later, interest rates jump to 10%. Now new bonds are paying 10%. Why would anyone buy your 4% bond for the full $1,000 when they can get a brand new 10% bond for the same price? They wouldn't. So if you need to sell, you'd have to discount your bond significantly to make it attractive enough that it effectively yields 10% for the buyer. This isn't just theory. Between 1980 and 2009, the 30-year Treasury bond yield ranged from a high of 16% down to 3%. Those swings happened over years, but they represent massive price movements. Now here's the critical part. Maturity length matters hugely. Short-term bonds, those maturing in 1 to 2 years, barely budge when interest rates move. But long-term bonds, those 20 or 30-year bonds, they can swing wildly. As a rough rule, a 100 basis point increase in rates, that's 1% in Wall Street lingo, can cause a 30-year bond to lose around 10 to 12% of its value. So, if rates go from 5% to 6%, your $10,000 bond investment might drop to around $8,800 to $9,000. But here's the flip side. When interest rates fall, bond prices rise, and longer maturity bonds gain more. This is why professional investors buy long-term bonds when they think rates are heading down. They're positioning for capital gains. Here's one critical thing to remember. If you hold a bond until maturity, none of these price fluctuations matter. You'll get your full principal back regardless of what happened in between. The price swings only affect you if you need to sell before maturity. Let's talk about the 3 main types of bond you'll encounter: Treasury bonds, municipal bonds, and corporate bonds. In the US, Treasury bonds are issued by the US government. They are considered free of default risk. meaning the chance of not getting your interest or principal is extremely low. It's as safe as it gets. The trade-off? They offer lower yields compared to other bonds. Municipal bonds, or munis, are issued by state and local governments to fund projects like schools and highways. The big draw here is that interest is usually exempt from federal taxes, and sometimes state taxes too, if you live in the issuing state. If you're in a higher tax bracket, this can make munis attractive, but always compare the after-tax yield carefully. Corporate bonds are issued by companies. These pay higher interest than treasuries because there's more risk. Companies can and do go bankrupt. The bond market grades these by credit quality, from AAA down to junk status. Higher ratings mean lower yields but safer investments. One quick note, even AAA-rated bonds aren't protected from interest rate risks. Their credit is rock solid, meaning they'll pay you back. But if interest rates spike, their price still drops, just like any other bond. Now let's look at the key risks in bond investing. Every investment has risks, and bonds are no exception. They may be safer than stocks, but bonds still come with three major risks every investor should know. 1. Interest rate risk. We just covered this. When rates rise, bond prices fall. All bonds face this risk. The longer the maturity, the bigger the price swings. If you want to minimize this risk, stick with bonds under 5 to 7 years. They'll be far more stable. 2. Inflation risk. This is the silent killer of bond returns. Let's say you buy a bond paying 4% per year. Sounds good, right? But if inflation is running at 3%, your real return, what you're actually earning after inflation eats away at your purchasing power, is only 1%. Here's a concrete example. If you lock in a 4% bond today and inflation averages 2% over the next 30 years, an item that costs $100 today will cost $181 in 30 years. Your bond payments stay the same, but they buy less and less every year. This is why longer-term bonds are riskier during periods of rising inflation. You're locked into that fixed payment while your purchasing power erodes. What's the worst-case scenario? The 1970s. During the 1970s, bond investors earned 4 to 6% nominal returns, but inflation was running at 12 to 14%. They were losing purchasing power every single year, even though they were getting paid. Now, for people who want inflation protection, there's a special type of bond known as the Treasury Inflation-Protected Securities, TIPS. TIPS are government bonds designed to do one thing: protect your money from inflation. Maybe I'll share more of that in a follow-up video. 3. Credit risk. This is the risk that the borrower won't pay you back. Rating agencies like Moody's and Standard & Poor's grade bonds from AAA at the top down to D for default. Higher risk demands higher reward. A junk bond might pay 8 to 10%, but there's real default risk. A AAA bond might only pay 3%, but your money is far safer. Now let's look at why bonds matter in your portfolio. So why would you buy bonds when stocks historically return more? 2 main reasons. First, income. Bonds pay regular, predictable interest on a set schedule. If you're retired or need steady cash flow, bonds deliver. Stock dividends can be cut. Bond coupons are contractual obligations. Secondly, stability and diversification. When stock markets crash, and they do, high-quality bonds typically hold their value or even rise. During the 2008 financial crisis, the S&P 500 fell by 37%. What of high-quality bonds? They held steady or gained. This is because bonds and stocks often move in opposite directions. When one zigs, the other zags. This smooths out your portfolio returns and helps you avoid panic-selling stocks at the bottom. That said, bonds aren't always appropriate for everyone. If you're young with decades until retirement, you can likely afford more stock market risk for potentially higher returns. But as you get older and your time horizon shortens, bonds become more valuable for protecting what you've built. One common approach is to gradually increase your bond allocation as you age. If you're 30, maybe 20 to 30% bonds. If you're 60, maybe 50 to 60% bonds. This isn't a hard rule. Your actual allocation should depend on your goals, risk tolerance, and when you need the money. Let me leave you with 3 practical tips. 1. Don't chase yield blindly. Higher yield always means higher risk. If a bond is paying significantly more than comparable bonds, ask yourself why. Often, the market is telling you something about credit quality. 2. Consider bond funds over individual bonds. A bond fund owns hundreds or thousands of individual bonds. You own a slice of all of them. For most everyday investors, bond funds or ETFs make more sense. You need diversification, and building a proper bond portfolio with individual bonds requires significant capital. Bond funds give you instant diversification and low-cost exposure. Some great examples of broad market bond funds include Vanguard Total Bond Market, Fidelity US Bond Index, and Schwab US Aggregate Bond. And for the last tip, pay attention to taxes. Municipal bonds might offer lower stated yields, but higher after-tax returns if you're in a high tax bracket. Run the numbers before deciding. Bonds aren't flashy. They won't make you rich overnight. But they're a fundamental building block of smart investing. They provide income, reduce portfolio volatility, and help you sleep at night when the stock market is going haywire. And now that you understand how they work, what they are, how interest rates affect them, the different types, and the key risks including inflation, you can make informed decisions about whether and how to use them. Remember, bonds aren't better or worse than stocks. They're a different tool for a different job. The question isn't whether you should own bonds, it's whether you understand them well enough to use them wisely. If you found this helpful, hit that like button and subscribe. Drop a comment below. Are you investing in bonds? Thinking about it? What questions do you still have? You may also watch these videos next. Thank you.